Good afternoon and welcome to the Future of Finance and the Securities Services Industry in the New World in partnership with Coalition Greenwich. I shall now pass you over to Dominic, Hobson and the panel. Thank you.
Hello everybody and welcome to our webinar, Securities Services in the New World, in which, in conjunction with our sponsor Coalition Greenwich, we review the recent financial performance of the global custodian banks and project near-term developments in the global custody industry. I'm Dominic Hobson, co-founder of Future of Finance, and I'm delighted to moderate our discussion today. We're going to begin with a short presentation by Eric Lee, Head of Securities Services Research at Coalition Greenwich. But before Eric does that, I'd just like briefly to introduce our other panelists. Philippe Benoit is Head of Strategic Business Development and Transformation at BNP Paribas Securities Services, a role which encompasses new and digitized businesses. Nadine Chakar is Head of State Street Digital, in which capacity she leads the bank's digital custody strategy. Chris Cox is the EMEA Head of Securities Services and Global Head of Data, Digitalization and Strategic Projects for Securities Services at Citi. Now, in addition to our panelists, we do also, of course, have you, our audience. We want your questions, we want your comments, so do please send them, keep sending them throughout the webinar using the Q&A functionality at the bottom of your Zoom screens. Rest assured, I won't be saving them all up to the end, but I'll endeavour to get our panelists to answer them as we go along, so you can be, if you choose to be, an integral part of this discussion right from the start. And I think I speak for all four of us when I say we'll be very disappointed if you don't take that opportunity, particularly in the light of the news last week. Now, with that, I hand over to Eric Lee, who will share with us some initial analysis and insights drawn from the work which Coalition Greenwich does with global custodian banks. Over to you, Eric.
Well, thank you very much, Dominic. Hello, everyone. Hope you are well and had a lovely summer holiday somewhere sunny. So I'm honored and delighted to be here and share some of our security services industry insights with you in the next 10 minutes or so. But first thing first, so if we go, for some of you who don't know Coalition Greenwich, so we are a world-leading provider of strategic, quantitative, and qualitative analytics insights provider to the broad financial services industry, including investment banks, commercial banks, asset managers, corporate security exchanges, and fintechs. We are formed with the merger between Coalition and Greenwich Associates last year. We are owned by Crystal, which is part of S&P Global. We specialize in providing very unique, high value and actionable information to help our clients improve their business performance. Our suite of analytics and insights encompass all the key performance metrics, particularly in our corporate and investment banking division. We help our clients with revenue opportunities, resource requirement, as well as client strategy. So what is our capability on security services? So our coverage are quite broad. You can see it in the next page, page 3 on screen, that we cover most of the products in security service industry. Please note that we don't just define the industry as custody and fund services. We also include agency-sec lending, issuer services, and collateral management. We cover different client segments, we cover different regions, we cover different industry players, either being banks or non-banks. And also we have a very, very detailed operating cost analysis. So that's a quick introduction of us. Now let's look at some of the stats on page number 4. So firstly, to set up the scene, let's look at the broader performance of the broad industry. On the left-hand side, the broad corporate and investment banking industry, which includes global markets, investment banking, transaction banking, and the security services. The industry revenue has been stable from 2016 to 2019. There were a little bit of improvement in 2010-2020 due to the heightened volatility, rising transaction volumes, as well as everybody rushing to financing during the year. Security services in this context is roughly 9% of the broad corporate and investment banking industry and is roughly $50 billion in size. Please note that This is the wholesale part of the business, so it's excluding retail custody as well as the services associated with that. If we look at the security services industry performance, we can see on the right-hand side that the industry actually grew a little bit between 2016 to 2018, which is a little bit different from the broader CIB industry. Then the security services industry revenue was stable from there onwards. On the far right-hand side of this page, so if we look at the first half of 2021, global revenue of the industry remained flattish despite that the equity market had reached a historical high. So what are the key drivers for that? When we're looking at the components of the industry, the custody revenue declined due to net interest income lower as well as lower custody FX revenue, especially in the first quarter of 2021. The decline was also partially offset by the moderate growth in fee income, and AUC and deposits balances continued to reach new high during the year. Fund services, on the other hand, the revenue improved due to higher AUA. The growth was observed in most of the categories, but particularly in ETF servicing, in alternative fund services, as well as front-to-back offerings. Here, we're also looking at performance across a few other businesses, including agency lending, issuer services, and collateral and clearing. We've seen significant decline in agency-sec lending during the year because of the lower spread. Despite that, the balances is actually holding up quite well. Collateral management revenue continues to grow, although the growth rate slowed down a little bit from the previous period. Some of you probably have guessed what we're going to talk about next. So on to the next page. The revenue growth of the industry is severely lagging the asset growth of the industry in the past 5 years. I think that all of you know it as a fact already, but we are the only third-party provider who can illustrate all of this in numerical terms on a regular basis. On this page, we are evaluating how much is the fee pressure that the industry is facing and what is actually the fee discount on the industry at the aggregate level. We're looking at AUCA, we're looking at the total fee revenue, as well as the total revenue, which also includes net interest income, as well as FX. The chart on the left-hand side is pretty easy to read. So on average, the AUCA for the industry grow roughly 10% a year. And when we're looking at the revenue, either is measured on the fee terms or the total terms, it grows roughly 3% every year. What does that mean? It means that the actual discounts the industry is giving out to their clients are roughly 6%, as illustrated on the right-hand side. So 6% is the magic number. The cumulative discount from the first quarter of 2016 to date is quite alarming. We are looking at 29% in total terms or 24% in fee terms. And if you watch the curve closely, you will also find that the shape of the curve is steepening, which means that the discount given out by the industry is actually significantly more in recent years comparing to the previous couple of years. So don't get me wrong, most of the industry players are in exactly the same boat. So then the next question is, how do they cope with this then? I'm sure that this will get discussed a lot within the next hour or so of the webinar. From a third-party observer perspective, we mainly saw two things. So on to the next page, page 6, you can see that, first of all, on the left-hand side, most players have invested heavily in the high growth area. So the left-hand side chart states that the industry grew 13% in fees during the 5 years from 2016 to 2020. The traditional custody and fund admin business, as marked in the light blue color, grew 5% during the 5 years, while the focused products as represented by ETF, alternatives, as well as front-back grew 37%. So this is where majority of the industry players have invested in the past 5 years. As a result of that, you can see that the weight of these focus products has grown to 27% of the total revenue, comparing to 5 years ago, it was 22%. The second biggest trends are industry consolidation. You all know who bought whom last week, so I'm not going to talk about that. So the data point you are seeing here is actually on alternative services. Why the industry growing enormous 53% during the past 5 years from 2016 to 2020. Majority of that growth was actually captured by non-banks through a combination of organic growth as well as acquisition. This is just an example. We have seen various forms of consolidation in every single business area of security services, and we have data points to support every single statement of that. So with that, I'm going to end my presentation here, and I hope you find this short presentation useful, and please join us for the upcoming panel discussion.
Thank you very much for that, that presentation, Eric. Could I perhaps come to you first, Philippe? The story which Eric told there was of an industry whose assets in custody and assets under administration are increasing very significantly, partly as a result of market valuations. At the same time, it has a problem in terms of growing both revenue and in particular growing revenue productivity. It's offering services at a discount, I think was the phrase that Eric used. And much of the growth seems to be going to non-banks as well. Now, there are lots of different things which could be done to rectify that situation. Consolidation is one which Eric has pointed out is being adopted already, but there are also cost-cutting measures, there are partnerships, there's outsourcing, there's setting up industry utilities. I don't know, you could shift to some whole new technology paradigm. There's a lot of talk about the cloud and how the industry needs to move towards the cloud and so on. What do you think just one other thought I see is when I look at the data which Eric showed about the investment in alternatives, I wondered if that didn't just represent a case of the industry following where the buy-side clients are actually going into passive strategies and ETFs. It's not actually creating a whole new revenue stream. It's kind of following the clients. So what do you think are the right measures to close the gaps, which Eric has pointed out? Philippe.
Thank you, Dominic, and thank you, Eric, for your presentation. I think this might not look glamorous, as Eric said, in terms of trend, but I would like to start to say that I always take the image that securities services is an industry within a banking world, in a way. So being in an industry, I think we should have this mindset in terms of mechanically being obsessed by transforming ourselves, reducing our cost. And I like even to say that we tend to have reasoning around unit cost, client profitability, like in an industry. So I think this is very important. So in that respect, I think we should not forget just one topic on the top line is, while of course you have the pricing pressure that Eric did describe, we are in an industry where the pool of assets will continue to grow. And mechanically, they will have some positive impact on the revenue side. But this is a side comment saying that at least we have an underlying trend that is rather positive for the entire industry in terms of assets. Coming to, let's say, cost industrialization. I think what you just briefly mentioned are all the tools that we need to be obsessed with, and I think with the objective of transforming. Definitely classical cost-cutting measure, but I think more importantly, recently, we have seen across the industry much more partnership, much more massive outsourcing, or utilities, as well as, of course, the path to technology. And I think all the tools are important and we should neglect none of them. I think in our side, to cope with a low interest level, for instance, as well, partnership is a good, it's a good segue. because it allows you to extend potentially your offer, but being at the same time a bit more frugal in terms of investment. So you extend your investment capacity, but leveraging partner. This is a good segue. We have done few indirectly. You have noticed last year a very visible transaction, maybe not as big as the one announced by Nadine and the State Street management team last week, but we made this partnership with Allfunds last year in the fund distribution space, very valuable. We are investing in the alternative, which is definitely a tailwind area for the entire industry. We invested in technology, taking stake in a German tech company called Asset Metrics to enlarge the capabilities of our platform, because this is probably a field that was underinvested technology-wise because it was less attractive 10 years ago, but we see still a gap today. And this is an area that is very manual today. So that's a couple of examples to show that the transformation need to encompass all the tools that you said. And after you need to move it forward through the organization.
Mm-hmm. Nadine, perhaps I could tempt you to give us a few thoughts now. Clearly, State Street has made a very interesting acquisition last week, but it's not the only thing you've been doing. You know, purchasing Charles River, for example, took you into a whole new way of servicing buy-side clients. What's your thinking about how to close this gap between revenue and profit?
Thanks, Dominic, and I do agree with what Philippe said. There's a lot of tools out there, and I would say our asset servicing industry has really had a really great track record at reinventing itself at every single decade. I think every single time somebody's announced the death of asset servicing and custody, I think this industry's found incredible resiliency and innovation and pivoting. And I'd like to think State Street has taken the lead there. Dominic, to your part, Charles River was key in creating this front-to-back offering that we've seen the rest of the industry participate in. And now with the acquisition of BBH, it just takes us one more level to help us accelerate our strategy, whether it is and remain as close as we can to our clients. There are a couple of things that I think we're seeing to help close the gap. It is the introduction of new products and services. I think in your introduction, you said, are we following the client? I think our industry has always been very client-centric, and in this very low yield environment, yes, everybody's paneling on whether it is crypto custody or it's the alternative space. And I think that's where you're seeing the investments, not only because our clients are moving there, but I think it's a part of the industry that's ripe, not to be disrupted, but to be reimagined. And I think today we have the tools, we have the know-how and the means to try to do that. So I'm as bullish as I was when I first started many moons ago. I think our acquisition of BBH just doubles down our commitment to this space, that we want to be better, faster, and continue to add more benefits to our clients. And we will leverage every single tool at our disposal, from the cloud to all the other good things you're going to talk about later, Dominic, around crypto, digital. So I think there's good things happening to this industry, and it's exciting to be in this space.
Could I just, before I let you go, Nadine, could I just ask you one specific question about the Alpha platform? Because it is an open architecture platform. It represents a whole new way of dealing with buy-side clients, of which you're going to get a whole lot more now you've acquired BBH. Do you see it as a platform, or do you see it as the beginning of a much more unusual strategy, I suppose, in which the world is moving towards some kind of decentralized data net, by which I mean the technology people often refer to this as fabric. In other words, you're going and collecting data from different places, you're making use of it as you wish. Whereas platforms of the type we've seen grow, Facebook's an obvious example, but Alpha initially at least is following that model. Are we looking here at a whole new paradigm, the global custodian bank as a data manager?
I think we are, Dominic, and we've never shied away from saying that part of our strategy is to be a data custodian. So obviously Alpha in general, Alpha Data Services in particular, and now gets like a massive turbo boost with the acquisition of Intermediary, right? That when you create and align both of them, just gives our clients an unbelievable capability to be able to consolidate their data, and that line between what data is custodied or not custodied just disappears, right? They become seamlessly integrated there, and we know. Our technology today is heavily dependent on good data, quick, clean data, which was really at the forefront of our front to back strategy, right? We wanted the ability of being able to take that data and pump it right through from front, middle to back. And now that was the first step. I think Intermediary being part of our arsenal just makes that a much faster reality, for lack of a better term. I also do believe that Alpha is a platform, and I do believe it's a good stepping stone among the other tools that we have, whether it is our global link platforms, it is a lot of the work that we're doing in the peer-to-peer space. I think these are all stepping stones to get us to an institutional decentralized finance environment, which in my opinion, I don't think will ever be totally decentralized for institutional investors. You still need a firm like a State Street or some level of credit intermediation in the middle, but it'll be a lighter touch and one where you're definitely putting clients really a lot in the driver's seat versus. So I think that's definitely, at least in our minds, the map, the blueprint of things to come. So definitely moving in that direction.
Thanks, Nadine. And Chris, I'd like to bring you in, and perhaps I could very unfairly throw at you the first question, which has been offered by a member of our audience, which is, do you think the enlarged gap, and he's referring to the gap between asset growth and revenue and profits, is that enlarged gap due to limited technology investment to build scale? And a supplementary to that is, where do you see the opportunity lies in banks to reimagine this space? Nadine's begun to talk about how you reimagine the space, but perhaps you could deal, Chris, with that first question. Is this a lack of technology investment that's causing the problem?
Great question. I think people will always ask for more technology dollars, but I don't think in absolute terms necessarily it's about the gap itself per se is to do with technology dollars. Let's be really clear. One of the largest drivers in this is just the dramatic reduction in interest rates over the last 18 months. It's an unprecedented headwind, both to clients and also the industry. That said, I think, look, margin pressure is all around us. It's around us clients. It's particularly focused in mainstream active management. You've talked about both low cost beta coming through and ETFs, and also what the growth in private assets. So certainly there are segments where we see real growth. The reality with technology investments is you have your legacy to maintain, you have your regulatory mandatory to respond to, and therefore the discretionary amount you get to invest is often perceived to be too little. But the reality also with technology investments is if you give someone a large sum of money to spend, it's actually incredibly difficult for them to spend it and spend it efficiently. So I would tend not to agree that enlarged gap is purely down to technology. I think there are very many drivers associated with it. I think we're all on a journey to be a little bit more rational about how we manufacture services, and Nadine talked a little bit about what they're thinking about. You also touched on this concept of open platforms. Open has many definitions. There's a definition, open in the sense of available via the cloud. That can still be a proprietary and tied system where clients have to choose and lock themselves in and out certain data architecture, and client data isn't perhaps particularly mobile. Open can also mean, similar things to open source, where the industry contributes to standards. And we think within finance, one of the bigger opportunities actually relates to the achievement of common standards, right? We all have our own data services. We all use different data models. We all use different standards. The industry is incredibly fragmented. We see utilities appearing to solve some of those problems. So one of the things I think we as a firm are interested in is looking at harmonization of that. If we could be more consistent in terms of how we exchange data, then some of the things Nadine alluded to, immediacy of data, speed of data transfer, we think feed through. And then if I play back what Philippe said, I mean, again, in terms of servicing a client, you can really broaden the relationship you have with a client. You know, a bank like Citi would obviously very committed to Securities Services. We're also a large universal bank, and therefore we can be an incredibly powerful partner to someone when you connect all of those various pieces. You know, Securities Services, markets execution, banking, advisory. So there are very many ways of skinning the cat. So I think also you need to recognize that if industry revenues are coming down in aggregate, it is very much impossible to become a much closer partner to people and grow your business. But the reality is the bottom end of the industry may get squeezed. And without putting words in Nadine's mouth, that may have been one of the drivers associated with the transaction that they did. So I think, you know, I would challenge the question, and I hope I've answered it, but I do think there is going to be an underlying theme of industry consolidation and bigger relationships with people, more strategic relationships with people, and trying to get, you know, your firms like Citi aligned with clients to really drive the growth in their business.
Thanks, Chris. I'm going to come back to that question of technology transformation, because I think it's a very interesting one that a member of the audience has raised there. Before we do, could I just ask you, Eric, a couple of things? One of the points you were making really was that the global custody industry isn't very good at keeping the benefits of the cost savings it does make. They tend to get passed on to the client. How can they change that? And secondly, Chris brought up the question of the unusually hostile monetary conditions at the moment. Prolonged period of very low interest rates, lower than ever right now. So what would happen to the industry if interest rates went up? You would kind of expect market values to go down and net interest margin to go up. But have you modeled whether that would have a very positive or a very negative or an indifferent impact on revenues and profits at global custodian banks?
Sure. So thanks very much, Dominic. That's a very, very good question. Put three questions together. So I'm trying to address them in the reverse order. I think it's a very popular debate between equity analysts that whether a high interest rate would lead to a lower equity market, which in turn attributes to a lower custodian fees. Our data actually shows that in the last rate rising cycle, so 2016 and onwards, the impact of a high interest rate was actually mostly positive for the industry. While I know that the past performance is no guarantee of future things, but I'm still rather convinced that if and when when a Fed lifts interest rates from 2023 onwards, it's still going to be net positive for the industry. Put aside the asset valuation questions aside, there's additional two factors we need to consider. First of all, being global custodians have by now more or less optimized their liability structure. I think that from our data, we've seen that happening very, very fast up until the end of 2020. So that is going to be a good tailwind when the rates rise. Second of all, it will for sure alleviate the pressure, especially the fee pressure on certain fixed income products. I know we talked a lot on the equity side, the equity market going up and down, but don't forget about in a lot of market, the fixed income portfolio is also important. And the fee pressure there is very, very different from what we've seen in the equity side. So that is what I would say on the interest rate side. On the whether custodians has sort of like passed along all their cost cutting to their clients, I'm afraid that we have data on cost, we have data on discounts. I think it's probably no surprising that during the past 5 years, all of these savings global custodians have done in the cost cutting through various cost cutting measures has more or less gone to their clients. It's not a long-term strategy because you are all business leaders, whether you're on the panel or in the audience. This is not a long-term strategy. So how do we actually change the paradigm? There's two things we can think about it. One is within the industry, one is outside of the industry. The first thing is, I think within the industry is cross-sale is key. Cross-sale into other areas, which is quite important, which does mean that the bigger and the broader your franchise is, the easier it gets. And then let's actually deal with the real question here. Why there's such acute margin pressure in the industry? If you think about the box, it is coming out of the natural competition between all the global custodians. But most importantly, the margin pressure is actually being passed along through the value chain. I don't think that the industry itself can fix itself by fixing your own problem. But equally, I don't think that the industry has the time and the fortune to say, let's wait for 10 years for the other part of the value chain to fix themselves so we can then look at ourselves. I think the most likely outcome is in the next 10 years, the industry is trying to fix their own problem, but at the same time, the other part of the value chain is trying to fix their problem. So the question for all of us, on whether you're on the panel in the audience, is what are you going to do with it? I think that you cannot just stay still, say, we're just going to do nothing and wait and see. The most likely, I think, strategy employed by most of the people probably going to be, they say, the magic bullets would be a combination of all the things, Dominic, you said, or Philippe, you said, and Nadine, you said, or Chris, you said, this is a combination of all the things together. But one thing I think a lot of people have not looked at is, have you actually ventured out to look at upstream or downstream of the business? This is where I think the industry's next focus points are, because equity markets or the capital markets has clearly valued different parts of this value chain differently. And there's a reason for that. So as a consumer, we are all very sensitive to supermarket price. We all understand there's a factory difference between factory price, wholesale price, retail price. As a security services industry, we should all also explore the same idea. The price pressure exists everywhere, but the magnitude of this pressure is different.
Mm-hmm. Does that mean you can give us a sense, Eric, of which of the various businesses which you cover, you know, the custody, the funds, the collateral management, the securities financing, lending, even the issuer services, you have an idea of which of those is most at risk of being disrupted? That price pressure getting too intense?
This is like not picking your favorite child, it's picking your least favorite child of all of them. So I think that we have seen an influx of disruptors coming from the fintech world in each of these areas. But if you look at what is actually, I probably say that in 10 years' time, there's two factors is going to drive into what sort of world we're looking at. The first of all is how far the tokenization is going to go. I think this is going to fundamentally changing the operational infrastructure of the industry, whether global custodians going forward is going to be a technology aggregator, or they're just going to handle their client relationships. The second biggest thing is whether there's going to be a creation of the financial behemoths outside of this industry is actually going to eat into global custodians' lunch. I would say this is probably by far the two biggest factors, as nobody knows what's going to happen in 10 years, but depends on the outcome of one of the two, the industry could look very, very different in 10 years' time.
Thanks, Eric. Now, Philippe, perhaps I could tempt you to address that point, and I'm sure, Nadine, you have some thoughts on this as well. But if we go back to a point which Chris raised, which is, you know, legacy systems, he kind of left that hanging there, but it is obviously very difficult for established major financial institutions with entrenched client bases simply to say, well, actually, we're going to switch to a whole new technology paradigm and keep the clients with you. You know, there's a very high risk with that. It's a very long payback period. It's not an easy thing to do. But at the same time, you've got all these technologies out there which could theoretically transform the economics of the industry. Robotics, which the industry has been toying with for some years, and it doesn't seem to have found it very lucrative. There's AI and machine learning, which again, it's using, but we're probably in the foothills of that. And then there's what Eric has just raised, the question of tokenization, blockchain-based networks onto which tokens of all kinds, non-fungible and security tokens, get issued. So my question to you is, how difficult is it for the industry to technologically transform itself over whatever time period you care? And secondly, under how much pressure is it to do that from these new blockchain-based networks, which are creating this tokenization threat? I just read an interview this morning with a major sub-custodian bank saying that in 10 years' time, everybody will be issuing security tokens, not securities. And you guys are in the securities industry, so if he's right about that, this is a very large and substantial black cloud somewhere on the horizon to which you have to respond now, either because it transforms your revenues or because it transforms your costs or because it does both. You probably lost the question I'm trying to ask in this, but it's really twofold. One is, how hard is it to transform yourself technologically? And secondly, how big a problem or opportunity is tokenization?
Thank you, Dominic. And I want just to rebound and to say that I share the optimism of Nadine and Chris as well, explaining in one way. Of course, we have some challenges within our industry, but we have been always good to reinvent ourselves over the last decades, and I'm still convinced we will do. And I can say that looking at all what the industry is doing as we speak, we see the energy of moving this forward. So I think in that respect, despite Eric's teasing our industry on the pressure, and even you fairly or smartly, Dominic, through your question, I'm still very optimistic about this. However, let's be fair. We need definitely to even further accelerate our transformation. And in that respect, you are right in spinning the question, because I think we have entered in a new, I would say, technology era, thanks to DLT, thanks to cloud. So we have new tools in a way that we can embark. However, these new tools come as well with challenges. I think, and you know, the banking industry in general is a bit conservative, which is naturally because our reputation is on the back of the trust we provide to our clients. So maybe in that respect, when you look at other players from the tech world, because they were less regulated, less sensitive to trust toward their clients, because it was mainly retail as a first step, and before a regulation framework was more challenging them. And we have seen recently that with all the privacy topic across the retail industry that has been imposed to the GAFAM. I think the banking industry has been a bit in that respect more cautious. So definitely we are embarking those changes, and this is part of our transformational journey. And no doubt when you read all the announcements from ourselves, but my colleagues here, whether it's State Street or Citi, we are definitely embarking into this journey. However, we want to make it right, and we need to accompany on one side our clients, but as well to be mindful that the regulatory framework has not landed yet. So there are a lot of action that we are taking with our clients, with regulators at the same time, to make things progress, to deliver tangible value. Among the challenges that you can see, I mean, there is one as well. I think it's Chris alluded that we have legacy infrastructure to deal with. And if you come to DLT, I think in the post market, you see clearly that one of the challenges of the DLT is that you need the business case is not easy to run, because you need to invest on top of your legacy infrastructure, and it could not replace it right away. It will take years. So not to mention the interoperability between the new technology and your legacy environment. So you have a lot of hurdles to overcome, and I think we are working on it. And that's the challenge as well of the new technology, to make sure that it will bring value to our industry. But definitely on a long term, I'm convinced personally that we will heavily embark that. But what I can't bet is exactly the pace. I've seen recent reports saying things will accelerate very quickly. But if you take digital assets in particular, I think the regulation will certainly as well accelerate and will try to normalize things. So the technology is not always running the race in respect.
Thank you, Philippe. Nadine, can I throw a similar question at you, really? Why not? You're head of State Street Digital. You've described the bank as embarking upon a data-driven strategy. Why not switch to a whole new technology paradigm, possibly blockchain, and turbocharge the growth of that data business at the same time as deal with this massive competitive threat which is looming from tokenization? Why not just do it? How difficult is it to do?
We are, right? We are, and I think both Philippe and Chris, in their own way, sort of described that you've sort of got to balance both. And Dominic, as you move, I don't view tokenization as a threat. I view tokenization as an enabler, and I also view that a lot of the fintech firms out there as enablers and not competitors. There is. Before I became a banker, I was, studying to become a doctor to follow in my father's footsteps, right? And there's a principle in chemistry from one of Philippe's countrymen that always said, like, nothing is lost, right? Nothing is created, all is transformed. And I think that is the part that we're seeing our industry moving into. So I think tokenization, regardless of the regulatory framework right now, does have some good applicability that we're looking at, whether it is from the way we operate internally to the way we interact with our clients. I do believe, Dominic, that you're absolutely right. I think the custodian's operating model will change. I think it will change for the better because of tokenization. And we are looking at new stacks. So you're absolutely right. As the head of State Street Digital, I'll tell you, if I don't write one line of code, I think I would have succeeded. I think there's a lot of good fintech companies out there that have done the work, but yet they tend to be either very retail driven or don't have the scalability and the resiliency that you need a global SIFI that you have most of us on this call represent, right? So there's an element there where a partnership between fintech and the asset servicing world, where we bring, more of a global footprint, we build more hardened infrastructure. And I'll tell you, for all the hoopla that's out there with these fintech firms and the new breed of providers, our clients are still looking to the likes of State Street, Citi, BNP, and others to really step in and lead. Because we do need to bring the old and the new together, right? No one is going to invest, at least not in the next decade, I could see. They're not going 100% digital, right? They're going to need both. So we do need to be clever on how we spend our tech dollars, as Chris indicated. We do need to bring the old and the new. Within the bank, I try to explain that as bringing the Jetsons and the Flintstones together. It happened, I think cartoons showed us the way a long time ago. So I do believe it will happen. I don't believe it's a threat. And I think it's really an enabler that's exciting for us and our clients, as far as, opening up the ecosystem. And this is where you're absolutely right. The words transparency, interoperability take up a totally new meaning, but they're done in a controlled, in a disciplined, in a safe environment, right? Like our clients' data is sacrosanct right now. We've got to exert every single effort to ensure that it remains disposal to them safe and at their service. So that's why I'm bullish. And again, I do believe, and we are looking to deploy new tech stacks. But the challenge is how do you make sure it seamlessly integrates with the old, so we can give our clients the best of both worlds. And that's at least where we're dedicating our efforts right now.
Can I just be clear on one point you're making there, Nadine? It's not necessary, I think you're saying, for the established global custodian banks to invest in blockchain and tokenization right now, because there are lots of fintechs out there doing the work already, and when they're mature and ready and they've moved away from retail institutions, you can simply buy them. Is that what you were saying?
That's not what I'm saying. I mean, we could still use them. We don't have to buy them. I think all of us, everybody on the screen represents an era where we were in this industry where we felt if we didn't build it ourselves, it wasn't good enough, right? Like, I think there are firms that had to manufacture their own pencils because they didn't believe that buying them somewhere else was good. All I'm saying to you, Dominic, is we have choices today. I mean, if you really think of what fintech has done to the finance industry, it pulverized it to its lowest common denominator, right? Like, there's thousands and thousands of choices out there, many blockchain providers, many smart contract providers. So I don't think it's necessary for us to reinvest all that and redevelop all that. I think we will invest. I think our job is to create an ecosystem that is easy and less confusing for our clients in the industry to leverage. So we will be investing. We'll be investing differently. I think Philippe said it earlier. We may buy, we may partner, we may take strategic partnership stakes in them. And that's the exciting part, is I don't have to worry about building everything. I have options at my disposal today where I can go to market better, faster, and cheaper, for lack of a better term.
Thanks, Nadine. And talking of choices, I hope your father wasn't disappointed by the choice you made in the end. Join the industry.
I hope not.
Now, Chris, we've had a question from Emre Sabici, who says, in his view, tokenization should not be evaluated without current decentralized finance DeFi practices, such as the tokenization of cash and trading of of tokens against stablecoins, I think is what he's saying. How do you see the securities industry responding to DeFi? Should the custody industry embrace DeFi, or should it externalize it? Chris, are you guys looking at DeFi and thinking there's lots of interesting stuff going on there which we ought to be part of?
Yes, in a word, but I think it's all part of the continuum you were just talking about. The banks originate from clients wanting a safe store of value. That's why we hold capital. One of the challenges with DeFi is, when the music stops, who's the store of capital? So I'm not about to say that DeFi as a movement isn't incredibly interesting for lots of technological reasons. The technology behind it, the security behind it, just simply how it reimagines transaction workflows. There's an incredible amount we can learn from it. I'm with Nadine in terms of time frame. Do I see it being the near-term revolution to distribution of assets all over the place in public networks? I struggle a little bit with that concept. If you're a large asset manager, at the end of the day, you probably want to be able to point to a bank who is your safe store of value. At Citi, and just to pick up a little bit on the line of questioning you had with Nadine, we are absolutely exploring tokenization and cryptography, all the way, the private network end of it, all the way to understanding more about the public network end of it. Obviously, there are many very public debates around the public side of things. We've made investments. We will continue to make investments in the private network space. Also, we're very interested in terms of how these things will work together, and this is also connected to the DeFi answer. If you have an industry with multiple different protocols, at some point that all has to come together, and that all has to work seamlessly in front of the client. So one of the other areas as a firm that we're looking at is the interoperability of cryptography protocols. And we're quite advanced in where we are on this space. And I think that is also another place that banks can become essential to clients. A lot of clients today, and there have been a lot of headlines about particularly the cryptocurrency space. But the reality is, in terms of traditional investors dipping their toe in that space, that is still a very early trend. If you actually look at the weight of assets held in the respective industries, there is the traditional space absolutely dominates that. We are very much about following the requirements of clients and making the journey for clients towards digitized assets, be they on traditional ledgers or DeFi ledgers. And we will go that journey, and in all instances, we will try and be the facilitator for clients to access those markets. We've made investments in a company out in Singapore, Bonded Value. It's a licensed digital exchange with a sub-custodian to it. And those are the types of things that we will pursue to raise the value prop for clients, but also go the learning journey.
I'm tempted to ask you, since you brought up standards and interoperability, the securities industry has made pretty clear it doesn't see the ISO 20022 standard as part of its near-term future, at least, because the business case simply isn't there. But then you've got all these blockchain networks on different protocols. You've got clients, you're not prepared to force them to adopt these new standards. Are we looking actually at a whole new way of interoperability occurring and needing to occur simply because we're evolving towards a world of networks, and the old way of having compulsory migrations to fixed point-to-point messaging and standards is simply going away? Is this an instance where the custody industry is actually thinking much further ahead than people who listen to what Swift has to say about it might think?
Look, I can't speak on behalf of the industry, but we as a firm, absolutely the answer to that is yes. Right?
Okay.
Technology is bringing new alternatives to market. The point I was trying to make earlier when you talked about open data architectures, the reality is every firm has its own data service on its proprietary platform. So do some of the OMS providers. Data standards are not common. When you look at transaction workflows, if you go from a marketplace transaction to an ICSD, there are 4 or 5 levels of duplicated data, duplicated technology, duplicated operations. If you were to design the industry today using modern technology, you probably wouldn't design it the way it operates.
Because that's a very forward-looking statement. Where do global custodians get paid in that vision of the future?
Because you offer a client a higher value proposition. You offer them a hedge on the future. You offer them future access to digital assets when they want to take advantage of that. In all instances, it's a service industry, and we're trying to elevate the service proposition to clients.
Could we talk a little bit about, we're into our last 10 minutes now, we could talk about the competitive landscape. And one of our attendees has asked this question. He's posed it to Nadine, but I think any of you could address it. On the competitive space, what do you see as the biggest threat to the securities services business? Do you see other non-banks invading this space and capturing wallet share? Now, Eric raised this, and clearly you see in the fund business at least, non-banks who don't have the same capital requirements, have a competitive advantage against banks. Nadine, I can see you're itching to answer this question, but why don't we ask Philippe to address it first? Who is the biggest competitive threat you face? Is it fintechs? Is it big tech? Is it non-banks? Is it, dare I say it, the stock exchanges who are getting into the data business?
That's a good call. It's maybe not as straightforward to answer, but I would tip it differently. I would say the first challenge is ourselves. I think whether you've heard Nadine, Chris, and myself, I think we all collectively recognize that we are under massive transformation because of the challenge of the industry, but as well as the opportunity to embrace new technology. So I think if we are smart enough to move through this transformation journey, I think the path will be there. And as expressed clearly by Chris, ultimately we are a safe for our clients, the trust, we have the capital, and this will remain still for a long term very important. Second angle is, of course, it's not only a question of competition. In our industry, we are competing and partner or clients of each other in a way. So in that respect, of course, I'm competing on a daily basis with Chris and Nadine's team on some mandates. But on the other side, we are both clients of each other. And we have even in certain cases, pushing forward some industry changes together, investing in some tech collectively to bring more value to the industry. So this ecosystem is in a way very unique as part of our industry. So I think, of course, let's not be naive. We might lose some revenue in certain fields just because we will industrialize it collectively on a greater way, and it will challenge a bit some of the revenue stream. But as alluded a bit earlier, on the other side, we are developing much more offer as we speak. Data management is a good example, and you hear that a lot in our industry. But data management is bringing new revenue stream, because ultimately, if we provide the right solution and the right tech stack behind, you simplify the lives of your clients and you remove them from the burden of going through part of their transformation journey because they outsource it to you. So I think in that respect is a moving target where you need to find our path. But I would say to end as I started, the biggest challenge is for us to be smart in moving forward our transformation journey.
Mm-hmm. Nadine, very quickly, because we've only got 7 minutes left. What's the competitor you fear?
Listen, I don't want to be arrogant enough to say we don't fear the new emergence of competitors, right? They're all nibbling at little pieces of the value prop, but I'll go back and reiterated what we said. As we're moving into a broader ecosystem, what we're going to do is enable anybody that can add value to the clients will be enabled in the asset ecosystem of tomorrow, right? Like I think that's a given. We're also not arrogant to think that our security, our capital is gonna neutralize them. But at the end of the day, don't forget, in the institutional world, most of the clients we deal with are actually holding monies of other individual clients, right? It's a different proposition from the retail world that you're seeing, right? At the end of the day, we're managing the dreams and aspirations of somebody we don't deal with on a day-to-day basis, but that fund manager is. I think everybody, I view everybody as a competitor, but at the same time, I view them as an enabler. And if they do and end up adding value to the client's value proposition, then we'll embrace them. And the value streams and the revenue streams, Dominic, are going to change. And while historically we made money by charging a basis point on assets and transaction fees, the pricing will be a bit different. And for every dollar lost, I think there'll be a new dollar made in this new ecosystem. It's just going to change. And I think we'll all have the intellectual flexibility to flex with it and adapt our models accordingly. But it's not something that's going to be done overnight. It's going to evolve because of all the things that we just talked about.
Mm-hmm. Now we're into our last 5 minutes, so I'd like to ask each of you a question. And Eric, I think I'll come to you last with this. Actually, it was good to get your neutral perspective on it. But clearly, doing nothing is not an option here, given the story which Eric told at the outset and everything which we've discussed over the last 45 minutes or so. What do you expect the financial performance and the market valuations of the leading global custodian banks to look like in, say, 5 years' time? Do you think we're going to see a transformation of those trend lines, which Eric showed? And could you name one or two really crucial changes which you need to make to start pushing those trend lines in the right direction? Chris, I know you've loved all afternoon the really difficult questions, so could I throw that at you first?
Well, the valuation piece, I'm not going to go there. That's pure speculation.
Fair enough. Yeah.
I think that we all work for both competitive institutions, but also institutions that hold our clients' interests and assets in the highest possible regard. So we're all going to be working really, really hard to offer, services that meet the requirements and create value for clients. So to Nadine's point, whether it is a basis point on custody, or to Philippe's point, we're now delivering outsourced data management as a service because that's the thing that's important. We will be building towards that. In terms of where the industry goes, tokenization, digitization of assets, I think we're all investing hard trying to pick the right technologies. I think no one has a crystal ball. The one trend I am confident about is consolidation. I think if you look at the markets space, and these are statistics I'm trying to remember off the top of my head, but from a very large global asset manager put them up recently, I think in the market space, the largest participants have between 12 and 15% market share. In the cloud provider space, the largest participants have 25 to 30% market share. Yet in the asset management space, the largest asset managers are still sub 5% in terms of total share of wallet. So I believe there will continue to be consolidation in the industry on both sides of the street. And for the larger firms, that is going to create new opportunities to broaden your service proposition to clients.
Philippe, what are the two crucial things? You've just heard Chris say that consolidation is going to be pretty key to
take of course, I don't disagree at all with Chris, but I will take another angle. What I think we alluded a lot about the new technology, whether it's cloud, DLT, what I find extremely attractive is the fact that it brings a tech debate not only in the IT division now, it's across the organization. And anybody is speaking about this up to COMEX, etc., even for profile that we are not involved in the tech side of our industry. So I think I see that as a massive transformation and a massive benefit, because I think it will help. We are still, to be fair, in the educational phase in some ways, but as soon as we will be out for that, I think it will accelerate the pace of transformation of our industry. So that's one of the first important topic. The second one, and I think we shared that as well with Nadine, is the fact that
we see the external world not only as competitors, and notably the tech, but I think more and more the partnership mindset that our industry is embarking now, it might be between ourselves, but with the tech world in particular, has as well accelerated over the last 5 years, but it's still the beginning. So I think I find it again very attractive because it pushes us to work in a different way and to find new collaborative model to bring value to our clients and to the stakeholders of this partnership. And I find that extremely attractive as well and exciting for our industry.
Mm-hmm. Thanks, Philippe. Nadine, digitalization, consolidation, partnerships, I'm sure there's nothing there you disagree with, but what about just Philippe's last point there about collaboration? Do you think utilities still have a part to play in transforming this industry?
Only if they transform themselves. And I'm starting to get worried about their positioning, to be honest. I mean, you look at SWIFT, you look at CLS, you look at PTCC, Euroclear, all the utilities we've grown up with. I think they need to start to articulate their future position, because I think Chris made that point, and Dominic, you did as well. This ship is about to leave the docks here, and they need to jump on board. So yes, of course, if they do enable our transformation, we will wholeheartedly embrace them, but we can't let them slow us down either.
Thanks, Nadine. A very interesting observation there about the utilities behind the curve, as it were. Eric, a last word from you. You've heard our panelists talk about how the industry can change itself, consolidation, digitalization, partnerships, and how the market infrastructures need to do something to support the industry and save themselves from extinction. So, what's your parting advice to this group of clients about how they can transform their financial performance over the next 5 years?
Sure. Thanks very much. So I think that despite I painting a rather alarming picture at the beginning of the webinar, I think that in 5 years' time, all of you guys, or the ones that's not on the panel, the big custodians, are gonna be doing just fine. Investors has been in love with this industry for a reason, and you guys today have talked about all the optimism and aggressiveness to actually future-proof your business model. This is exactly what we're going to see in the next 5 to 10 years. What I think that what Nadine's finishing statement on the utility, I think this is actually going to be a very interesting thing to watch out in the next 5 to 10 years, because something we have not talked about is the SNC plus DST, the State Street plus Charles River, the LSE plus Refinitiv, the Deutsche Post plus somewhere else. So we're going to see a lot of these things. Everybody, as I said, everybody's in the same boat. We're all trying to figure out a way how to manage in the value chain, value pressure. As a result of that, I think that this is going to be a very exciting space to watch in the next 5 years. Life is never going to be boring.
Well, on that last point, we've had a very interesting observation from a member of the audience who says he doesn't recall an interview with Swiss digital exchange STX. I think they can bring a different view to this topic, and I think that fits very neatly into what you were describing just there, and what we were touching on earlier to do with exchanges as being a kind of possibly hidden influence over what happens to this industry. But sadly, I think we must stop there. I'd like to thank our panelists, Philippe Benoit from BNP Paribas, Nadine Chakar from State Street, and Chris Cox from Citi, and of course, Eric Lee from Coalition Greenwich. And thank you, the audience, as well, for your engagement with this subject, and especially for your questions and comments. Future of Finance, our next event is 2 weeks tomorrow, Tuesday, 28th of September, where we're talking about how to fix the seemingly ineradicable problem. And Nadine brought up CLS and SWIFT, but the problem we're going to address is the cost of making cross-border payments. And I hope lots of you can join us then, please do. But for now, it's goodbye from the 5 of us. Thank you and goodbye.
Bye-bye.
Thank you.